The Fed just moved, and euro to US dollar is sitting on a 30% hike probability trap at 1.1447. The 200 EMA is right here at 1.1447, that's the line. Break above and we run to 1.1485. Reject and the liquidity sweep targets 1.1360. The herd is long, that's the danger. Full breakdown with both scalping entries and a swing plan. Link in description. Tap now before the move happens. The trade is set. Don't get caught wrong-footed. The Federal Reserve just delivered its decision, and euro to US dollar is sitting at 1.1447 with a 30% chance of a hike that nobody saw coming 2 weeks ago. The market is coiled tighter than it's been all month. Most traders are looking at this green candle and thinking buy. That is exactly the trap. There is one danger zone and one hidden opportunity right now. I'll show you both. Here's the reality. The 200 period EMA sits at 1.1447. That's not a coincidence. That's where we are trading right now, to the pip. The 25-day moving average is at 1.1410. The 50-day is at 1.1485. Price is trapped between two moving averages that have defined a range for over a month. Stay to the end. I'm giving you 2 scalp plays and 1 swing trade you can execute today, plus the one headline that flips everything. The Fed just announced. Kevin Warsh is speaking. And the market is about to make a decision that separates winners from losers. Let me declare the session bias right now. We are range-bound with a bullish short-term tilt, but the bears own the higher time frame structure. The weekly trend is sell. The daily trend is neutral. But the 4H and 1H trends are both strong buy. That's a battle between timeframes, and those battles create the best trading opportunities. Write this number down. If we break 1.1485 today, the entire structure resets to bullish. That's the 50-day moving average and the 6/8 Murray level. A daily close above that and we are targeting 1.1620, but if we reject and break below 1.1360, the bears take full control and we are looking at 1.1325. The July 28th low and a major liquidity zone. Here's what the herd is doing. Large speculators increased net short exposure to a 17-month high of 41.4K contracts. That's a massive bearish bet. But here's the problem for the bears. That's a crowded trade. When everyone is short and price refuses to break down, you get a short squeeze. The highest volume concentration for the current contract is in the 1.14230 to 1.14500 range. That means institutional money is parked right where we are trading. That's not an accident. That's a magnet. Let me walk you through the chart from the top down. On the weekly, euro to US dollar is neutral. We've been in a multi-week descending pitchfork channel since April. The bears have been in control since the April 17th breakdown, but the past 4 weeks have seen minimal price action. We are consolidating, not trending. On the daily, we are neutral with a bearish bias. The 200-day moving average sits at 1.14547. We are trading just below it. The 100-day is at 1.14542. That's a double. Moving average resistance wall right above us. The 50-day is up at 1.1473. That's the big one. Now drop down to the 4H. This is where it gets interesting. We have strong buy on the 4H and 1H timeframes. The pair has been carving higher swing highs and higher swing lows on the 4H since the July 28th low at 1.13537. That's a short-term bullish structure within a longer-term bearish framework. The RSI on the daily is 52.47, dead neutral. The stock is 34.55, oversold but not extreme. The MACD on the daily is minus 0.003, barely negative. The ADX is 24.68, that's a weak trend. When ADX is below 25, you're in a range. And that's exactly where we are. Here's what most traders miss. The CCI is 30.20, neutral. Williams %R is minus 28.46, not oversold. Every single indicator is screaming one word, indecision, but on the 4H, the MACD is showing early signs of bullish momentum. The 1H MACD is already positive. That's the divergence I'm watching. The 200 EMA on the 1H is at 1.1447, that's our current price. The 21 SMA is at 1.1381. The 5/8 Murray level is at 1.1360. These are the levels that matter. Here's a fresh insight. Just this morning, EFX data flagged that huge FX option expiries near 1.14 are creating a magnetic effect, pinning euro to US dollar in tight ranges. Related cash hedging flows are helping keep price near the largest strikes. That means any breakout will need real momentum, not just a spike. The descending channel resistance that has capped rallies for over a month is being tested right now. A decisive break above the channel and consolidation above 1.1400 would be seen as a positive signal for the euro. But here's the counterpoint. The bears have swept liquidity below the August 1st, 2025 low and above the July 2nd high. That's a classic stop hunt pattern. Both sides have been cleaned out. Now we wait for the next impulse. Now let me connect the news to the price action because this is where the real edge lies. Last week, the ECB left its deposit rate unchanged at 2.25%. That was expected. But here's what the market is pricing. A 95% chance of a 25 BP ECB hike in September. MUFG expects one final 25 BP hike in September to 2.5%. UOB agrees. One final hike in September followed by an extended pause. That's the euro support story. The ECB is still in tightening mode. Now look at the Federation. The FOMC decision is today. Markets broadly expect rates to remain unchanged at 3.50% to 3.75%. But here's the twist. Hike odds have climbed from just 18% 2 weeks ago to over 30% today. According to Action Forex, Kevin Warsh has no tolerance for inflation. That hawkish rhetoric has pushed hike odds up sharply. He has deliberately scaled back forward guidance, meaning tonight's press conference may offer fewer clues than usual. That's a recipe for volatility. ING notes that euro to US dollar has rebounded above 1.14 on lower oil prices, but argues the move looks optimistic. Meanwhile, Commerzbank argues the FOMC under Warsh is likely to deliver a hawkish hold, with markets already pricing at least one Fed rate hike by year-end. The geopolitical backdrop adds another layer. A diplomatic pause in Middle East hostilities has pushed oil below $100 a barrel, softening safe haven demand for the dollar. But Iran has reinstated the blockade of the Strait of Hormuz. This is a fluid situation that could flip at any moment. Here's the cross-asset linkage I'm watching. If the dollar breaks 105 on the DXY this week, euro to US dollar is heading to 1.1320. If the dollar weakens, we are going to 1.1480, 1.1500. Do you think the dollar breaks 105 this week? Comment yes or no. I'm tracking consensus. The futures market puts the odds of the ECB and Fed raising rates in September at 90% and 77%, respectively. That's a hawkish repricing that is already baked in. The question is, what happens if the Fed surprises today? A 30% probability is not negligible. That's a fat tail that the market is not fully positioned for. One more thing. The Eurozone July PMI increased to a 5-month high at 51.9. That's a recovery in both services and manufacturing. The Eurozone economy is not collapsing. It's stabilizing. That's the fundamental support for the euro that most dollar bulls are ignoring. Most people skip this section. That's exactly where the money is made. Keep watching. I'm giving you 2 scalping strategies and 1 swing strategy with exact entries, stops, and targets. Write these down or screenshot now. Strategy 1. The opening scalp, scalping, high probability. This is a 5-minute structural trigger. Right at the 1.1415 to 1.1422 support shelf. Here's the logic. The 25-day moving average is at 1.1410. The 1.1400 to 1.1420 region has capped rallies 3 times in the past fortnight. A retest of that broken resistance as support is a classic setup. The trigger condition. Price taps 1.1415 and prints a bullish engulfing or hammer on the 5-minute chart. That's your signal that buyers are stepping in at the level that matters. Tight stop loss at 1.1395. safely beneath the daily VWAP line and the 21 SMA, take profit 1 at 1.1455, testing the local 1-hour resistance block. That's a 40 pip move with a 20 pip stop. Risk reward of 1 to 2 to take profit 2 at 1.1485, the 50-day moving average and 6/8 Murray level. What instantly voids the scalp? A 5-minute candle closing below 1.1390. That breaks the support structure and invalidates the bullish thesis, the opening SCLP entry at 1.1415, 5M bullish engulfing after the tap, stop loss at 1.1395, take profit 1 at 1.1455, take profit 2 at 1.1485, risk and reward ratio is 1 to 2 invalidation. Void if 5M candle closes below 1.1390. Strategy 2. The liquidity grab, scalping, counter noise. This is the counter trend play. And it's the one that separates the pros from the retail crowd. The 200 EMA sits at 1.1447. The 100 and 200 daily moving averages are at 1.14542 to 1.14547. That's a triple resistance wall if price spikes up into the 1.1485 to 1.1492 supply zone, the 50-day moving average and 6/8 Murray level. We are looking for a fake breakout rejection. The herd. We'll see the break and pile in long. That's exactly when smart money sells. The trigger condition. A sudden spike into 1.1485 to 1.1492 followed by a bearish engulfing or shooting star on the 15-minute chart. That's your signal that the breakout failed. Stop loss at 1.1510, just above the spike high, take profit 1 at 1.1435, back inside the range and targeting the nearest intraday liquidity pool. Warning, this requires fast execution. The spike will be violent and the reversal will be just as fast. Don't hesitate. What voids this trade? A 15-minute candle closing above 1.1510. That would confirm the breakout is real and we are heading higher. Are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits. The liquidity GROB entry at 1.1485 to 1.1492, 15M bearish rejection after spike. Stop loss at 1.1510, take profit 1 at 1.1435, risk and reward ratio is 1 to 1.5 invalidation. Void if 15M candle closes above 1.1510. Strategy 3. The session swing, trend alignment. This is the big one. This is the trade that captures the multi-session move based on the 4H and daily bias. We are looking for a bullish swing if the Fed delivers a dovish hold or a bearish swing if we get a hawkish surprise. Here's the bullish swing setup. A daily close above 1.1422, the monthly opening baseline. That confirms the breakout from the descending channel. The trigger condition is a 4H close above the 60 MA with a bullish MACD cross. That's your institutional entry signal. Entry zone at 1.1425. Buy stop on a clear daily verification above the monthly open. Stop loss at 1.1350. Position safely beneath the major multi-week double bottom floor at 1.1320, 1.1325. Target 1 at 1.1575. Retest of the upper horizontal pitchfork channel boundary, target 2 at 1.1670. Major multi-month horizontal resistance turn support flip zoned. Here's the bearish swing setup. A daily close below 1.1360. That confirms the breakdown from the range and invalidates the bullish structure. The trigger is a 4H close below the 21 SMA entry zone at 1.1355. Sell stop below the July 28 low, stop loss at 1.1415, back above the broken support, target 1 at 1.1320, the major support zone, target 2 at 1.1280, the August 2025 to July 2026 consolidation range breakdown level. Trailing stop rule: once price reaches halfway to target 1, move stop to break even. Let the winners run. The explicit invalidation level that shifts the medium-term outlook. A daily close above 1.1485 for the bearish view or below 1.1360 for the bullish view. That's the level that confirms the trend has flipped. The session swing. BULSH entry at 1.1425. For H close above 60 MA with bullish MACD cross. Stop loss at 1.1350, take profit 1 at 1.1575, take profit 2 at 1.1670. Risk and reward ratio is 1 to 3.2 invalidation. Void if daily close below 1.1360 the session swing, RSH entry at 1.1355, for H close below 21 SMA, stop loss at 1.1415 take profit 1 at 1.1320 take profit 2 at 1.1280 risk and reward ratio is 1 to 2.1 invalidation. Void if daily close above 1.1485 never risk more than 1% to 2% per trade. Scalps demand even tighter risk. I recommend 0.5% to 1% for the fast plays. No positions through high-impact news. Stops are non-negotiable. That gap between 1.1415 and 1.1395 on the opening scalp? That's 20 pips. That's your line in the sand. Respect it. This is how you survive to trade the next big move. The Fed is speaking. The market is about to move. Don't be the trader who gets caught without a stop. Let me summarize the single most critical level for the next session, 1.1447. That's the 200 EMA. That's the line that separates the bulls from the bears. A daily close above 1.1485 confirms the breakout. A daily close below 1.1360 confirms the breakdown. Everything else is noise. The Fed decision is the catalyst. Kevin Warsh's words will determine the direction. If he sounds hawkish, the dollar rallies and euro to US dollar drops to 1.1320. If he sounds dovish, the dollar weakens and we are going to 1.1485 to 1.1500. That's the binary outcome. That's the trade. If this level breaks, the whole monthly trend flips. I'll have the updated blueprint 24 hours from now. Here's what I want you to do. If you want the full breakdown on trading commodities, Aussie, Japanese yen, Eurodollars, and Bitcoin, the videos are live now. Tap the end screen. Then hit the bell so tomorrow's alert lands before the open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter. The Fed just decided. The market is about to move. The setups are right here. The levels are clear. The only question is, will you execute? If you want the full breakdown on Aussie dollar, Japanese yen, Nike 225, those videos are live now on our Alpha Market Meridian channel. Gold, Nasdaq, and Bitcoin are published on the Market Meridian channel. Please click the link at the top of this channel's homepage to access the complete institutional suite. Tap the end screen to jump to the gold melt-up analysis, and then loop back to today's Nasdaq Gamma flip later.